Okay, well, thank you so much for being here and for the organizers of this very nice workshop. So as Silvia said, I'm Lilian, and this paper is co-authored with Natalie, who's also a PhD candidate at the University of Campinas. And the title of this presentation is Foreign Shocks and Monetary Policy Effects on Inflation Inequality. So I think everybody here agrees that monetary policy is a redistributive tool by its very nature. And I think even if there is a lot of diversity in its effect, it's for sure determining the flow of income that goes to asset owners. And then we can discuss all the other mechanisms that can lead to changes in distribution. Well, if we restrict monetary policy to interest rate setting and then assume an inflation targeting regime, this means that also this regime will have important distributive effects. And this has been emphasized by the PK literature for a while already, and it's still a literature that is growing. Our idea in this paper is to argue that these effects are very complex. And there are two main reasons, which are the motivation for us. Of course, there are other reasons for why this effect is complex. And I think in this sense, our work relates a lot with yours, because it's kind of trying to see that things are not so clear, to show that things are not so clear, but in a different way. So the first reason why is that there are different types of inequality, as we heard today in the morning, and that will be affected by inflation and by monetary policy. So of course there is income inequality, but then also if you get the Gini index, it can be telling you only part of the story. Then there is wealth inequality, which can go on the other direction. And there is also inflation inequality, which is well, I will explain that concept in a bit, but it can also be a relevant variable. If we want to see what people's standards of living is what's happening to people's standards of living. Another reason why this is complex is because if we consider the exchange rate as one of the transmission mechanisms of monetary policy, and in countries such as Brazil or other emerging market economies, this is considered the main transmission mechanism of monetary policy, we can show that it will have different partial effects, which means that the effect of the interest rate will be uncertain. And in this work, what we do is to extend the framework that we developed in the chapter of the Future of Central Banking book, in which we showed that this relationship can be uncertain because of the exchange rate. And now extend it by incorporating the idea of inflation inequality and analyze what happens when we have an inflation targeting regime that is responding to one specific inflationary source, which is a foreign shock. And the reason for this is because it can be assumed to be kind of an exogenous shock to the system, and also because it's very relevant now, as I will show. And then try to capture different economic structures to show how the results can differ depending on which country you're talking about, the specific time, and so on. To do so, we build an open economy conflicting claims inflation model, which has two classes of workers, and the model is simulated. And then we have these different economic structures that are basically characterized by different parameter values. So to begin with, I think it's important to explain the concept of inflation inequality. Basically, each one of us has our own consumption basket. And since the price of goods changed in different ways, we would all have our own inflation index. But since income groups and social groups tend to consume similar goods, we can say that they share a similar inflation rate. So within groups, it wouldn't vary that much, but across groups, it varies a lot. Therefore, when we look at the aggregate CPI, it's just an average that can sometimes represent the whole distribution of households, but sometimes it's not providing a lot of information. So inflation inequality would be the difference in inflation experienced by the different income groups. And this is, of course, related to the types of goods that they consume. So one big example of inflation inequality that's a lot in the media right now is after the beginning of the Ukraine war, the huge increase in food prices and fuel prices, which has had an impact that was stronger in the bottom of the income distribution, because these are the households that spend more on food and prices that are affected by fuel prices. And in some countries, the difference is not so big between the inflation rate experienced by the first quintile with respect to the 50th quintile. But of course, in other countries, it's quite large. And there's only 2 exceptions in the data, but you see that there is a huge increase in inflation inequality in European countries. Another example, which is way less mentioned, occurred in Brazil. And this was actually the motivation for this paper, but now because of this shock related to the Ukraine war, it's something that is again in the media. But in the beginning of the pandemic in 2020, Brazil was actually very close to its inflation target. So the line in the middle was the CPI in Brazil, which is used for monetary policy. And this led to reductions in the interest rates and so on. But at the same time, and different from the previous year and in the following year and also in 2022, the inflation rates per income group were super different. So if we look at this data here, the high income group had an inflation rate which was just 60% of the CPI, while the very low income group had an inflation rate which was 140% of the CPI. So they were experiencing very different inflation rates. And the reason behind that was related to the fact that services prices weren't increasing that much because of the pandemic. But since there was a decrease in interest rates and the currency was devaluating, price of foods were increasing a lot. And this hurts more the poor because they are the ones consuming more of those tradable goods. So this led to an interesting debate because, well, the country was very close to its target. And since Brazil historically has very high interest rates, it could be a good opportunity to finally decrease those interest rates as it occurred in the period. But at a certain point, some people were saying, okay, maybe we should be happy that we already reduced our interest rates and avoid further reducing them, because this may create more currency depreciation, which will again lead to further increases in prices of food and therefore hurt more the poor, who were already more affected by not only the pandemic situation, but also by the increasing food prices. So in that context, even some people who are very progressive were arguing against further decreasing the interest rate. And this makes the whole picture very complex when we want to discuss these relationships. So this was the motivation for this paper. And as I said, it relates to what we are experiencing right now as well. So why is this important? Well, first of all, I think we have to acknowledge the fact that inflation inequality matters for how people live. If we want to talk about income inequality, it's not because we care about income inequality, it's because we care about how people live. And therefore, we have to consider also what's going on with inflation. Another reason for this is that inflation inequality is used quite often to defend the IT regime, the inflation targeting regime. There's data for the US, for instance, that shows that inflation hurts more the poor. This is true to some extent, but, and also as I showed in the case in Brazil in a specific period. So acknowledging the fact that, okay, this matters, it allows us to reframe the debate and also offer some criticism while taking seriously a point that is made by some people who defend the IT regime, which is a valid point to some extent. So this is our idea in this paper, and this is why we consider this dimension as well. So let me just go before this. So as I said, what we do in the paper is to apply a foreign shock, which is an exogenous shock that affects the price of tradable goods. This is how we are having a shock on inflation inequality. But as I mentioned also in the previous work, we had shown that the effect of the IT regime may depend on the structure of the economy. So how do we consider this in this work? Well, one of the mechanisms by which interest rates can affect inflation and income distribution in an economy that can be modeled by the conflicting claims inflation model is through economic activity. So if we assume that lower interest rates lead to higher investment, higher consumption, and that reduces unemployment rates, workers will have higher bargaining power, they will gain nominal wage increases. Part of this nominal wage increase will lead to a change in the wage share. What is not leading to a change in the wage share will be reflected in higher inflation rates as firms try to protect themselves by increasing prices accordingly. So through this framework, we would have a lower interest rate being related to a higher inflation rate, but at the same time, a higher wage share. So an improvement in the functional income distribution, and therefore the situation would be can be good for workers in general, despite the higher inflation rate. On the other hand, if we consider the exchange rate, which, as I said, is one of the main transmission mechanisms in emerging market economies, we would have that a lower interest rate leads to a currency depreciation. This by itself leads to higher inflation rates, as was mentioned here before, but it also tends to lead firms to have a better situation with respect to their international competitors. Therefore, they can increase their markups. Well, this can be associated with a decrease in the wage share in this case. So what we would have in this case is that a lower interest rate is still related to a higher inflation rate, but with a lower wage share. So it's easy to see that if we consider, at least at the theoretical level, that these mechanisms may be there, we would have uncertain effects of decreasing the interest rate on the wage share, although the effect on the inflation rate, I know that there are other mechanisms that would suggest the opposite, but considering these two, lower interest rates would be associated with a higher inflation rate. So the effect on the functional income distribution is uncertain and depends on the strength of the different transmission mechanisms. Well, this was what we did in the chapter, as I said. What we do now is to actually write all the equations of the model and then simulate it by considering also inflation inequality. So how do we do the model? As I said, we have two classes of workers. So we divide workers into low and high wage workers, and we assume that the share of their nominal wages is constant. So basically the distribution between wages doesn't change in the model. And of course, the high wage workers earn more than the low wage workers. And the high wage workers are less than 50% of the population. This is just a parameter in the model. It doesn't matter that much for the results. Then what is really different here is the fact that workers have different consumption baskets. So the low wage workers, as we have evidence in the literature, they will tend to consume more tradable goods, which are prices that are more exposed to foreign, well, they are set in the foreign market, therefore they depend on the foreign price and also on the exchange rate. And then we would have a price index for each type of worker, which depends on the share of the domestic goods that they consume times the price in domestic currency of those goods, plus the share that they consume of tradable goods times the price in the foreign market times the exchange rate. And as I said, according to the literature, we assume that the share of non-tradable goods in the consumption basket of the high wage workers is higher than the share in the low wage workers. This gives us also the average consumption basket price index, which is just the weighted average between those indexes. And what we assume here is that this is the index that will be used by monetary policy in the IT regime. So it's not favoring any group, it's kind of having a neutral effect. Then we assume that prices in the foreign market denominated in foreign currency grow at a constant inflation rate. This is the variable that will suffer shocks in the simulation, as I will show. And domestic prices follow the dynamics of the conflicting claims inflation model, especially the extension to an open economy by Blecker. So basically prices grow with the inflation rate. The inflation rate depends on the gap between the wage share that was obtained in the previous period and the wage share desired by firms. And the wage share desired by firms is a negative function of the real exchange rate. So basically this is the link that connects the real exchange rate with income distribution through firms' side. Then similarly, workers will determine to some extent the dynamics of nominal wages. So nominal wages grow with the wage inflation rate, which depends on the difference between the wage share that workers desired and the wage share that was realized in the previous period. And the wage share desired by workers is a positive function of the capacity utilization, which is a negative function of the real interest rate. So this creates the mechanism that operates through economic activity. And here capacity utilization is a proxy to unemployment rates in the economy. Monetary policy follows the IT regime. So basically, whenever the average inflation rate is above the target, the nominal interest rate increases. And it uses the democratic index, which just means that the the average inflation rate is weighted by the number of workers and not their incomes. So this is just a detail. And then the exchange rate adjusts to changes in the interest rate differential. So whenever this differential increases, there is a currency depreciation, which then links the dynamics of the nominal interest rate with the exchange rate, and therefore with prices and the wage share. And the real exchange rate is just given by the standard formula. So what we do in the experiments? Well, we apply a shock to the foreign inflation rate, which is a parameter in the model, at time 500, and then it goes back to the previous level. So for 20 periods, the foreign inflation rate will be 2 percentage points above the baseline value. Then we have 3 scenarios, and they are characterized by different values of two key parameters. So one is the gamma, which is the sensitivity of capacity utilization rate to the real interest rate. So it's one of the transmission mechanisms. The other one is the xi, which is the sensitivity of the nominal exchange rate to changes in the interest rate differential. So this would be the exchange rate transmission mechanism. And all scenarios have the same kind of setting of the IT regime, so the same sensitivity of the interest rate to change to the inflation gap. Well, these are the scenarios. So basically in the baseline scenario, as I said, all of them have the same whole, which is the sensitivity of the interest rates to the inflation gap. In the baseline scenario, we have both transmission mechanisms active. In the ER scenario, the gamma is equal to 0, so we only have the exchange rate transmission mechanism. In the UT scenario, we have the opposite. We don't have any sensitivity of the exchange rate to the interest rate differential, but capacity utilization is the transmission mechanism of the IT regime. Then what we do, as I said, we have the same foreign inflation rate for all scenarios. And at time 500, we apply a shock. So it increases from 2% to 4% for 20 periods, and then it goes back to the baseline scenario. Well, this shock has an effect on inflation rates in the domestic economy, as shown here. So basically, it increases for all scenarios, as we would expect. And this is not only an imported inflation component, it actually has also a domestic component, because also the aspiration gap increases. So the aspiration gap in the post-Keynesian framework is the difference between the wage share desired by workers and the wage share desired by firms. And whenever this is larger, inflation will also be larger. So the fact that it increases here means that also the way domestic agents are behaving is creating inflation. It's not only because prices of tradable goods increased. And the reason for that is because there was a currency depreciation. So a shock in the foreign inflation rate leads to a currency depreciation automatically. And this leads to changes in the terms of the conflicting, the conflict over domestic income, and therefore creates some inflationary pressures also. As a response to the shock, there is an increase in the nominal interest rate. And as would be expected, when we have two transmission mechanisms, both of them are kind of helping each other to achieve the target. So the increase in the interest rate is smaller than when we have only one. And then, of course, I wouldn't focus too much on the fact that in the ER regime, the increase is slightly less than in the UT regime. This depends on the parameters as well. But in comparison with the baseline, they would require higher increases in the domestic interest rate. Well, this leads to an increase in the real interest rate as well. And there's a currency appreciation, currency appreciation in nominal terms when this is a valid transmission mechanism. Once again, this increase is larger in the ER scenario because this is the only scenario. And it basically means that in a way to fight the shock, the shock in foreign inflation rates, there is a currency appreciation, so it decreases the exchange rate, and therefore it kind of controls the growth rate of the foreign prices when converted to the domestic currency. And also by having an effect on the real exchange rate, it will attenuate the increase in the real exchange rate and therefore control this inflationary dynamics through the firm's side. So as you see here, the main implication of having this ER scenario is that although in all scenarios you do have a currency depreciation, it will be reduced when the exchange rate appreciates. And this is not the case when we have only the capacity utilization as a transmission mechanism. And it's somehow the case when we have both of the mechanisms. So the way that the monetary policy is operating in this case is by appreciating the nominal exchange rate. Well, in the other case in which we only rely on the capacity utilization, we actually have that there is a reduction in capacity utilization. And again, the reduction is larger when in the UT scenario, because this is the only type of control in domestic demand that you would have that then would have implications for the inflation dynamics in the domestic economy. So it's larger than the baseline scenario. And what happens in this case is that, well, there is a reduction in capacity utilization. This leads to a worsening in workers' bargaining power, and therefore it can reduce the inflation rate, but by affecting how workers affect the conflict and therefore putting the burden on workers. So these two mechanisms are kind of operating in different ways to control the inflation rate. Well, with respect to income distribution, in all scenarios, initially we have a reduction in the wage share. And this is because there is a currency depreciation. So after the shock immediately, which has a negative effect on the wage share. Nevertheless, when in the ER scenario, because there is a currency appreciation in nominal terms, the depreciation of the real exchange rate is somehow attenuated, and therefore there is a smaller reduction in the wage share. In the baseline scenario, it's kind of the average of these two effects. But in the UT scenario, what we have is that the response of the IT regime is further decreasing the wage share because it's actually reducing economic activity and therefore reducing the nominal wage increases and therefore having a bad effect on income distribution. So in one case, it's attenuating a process that was initiated by the French shock. In the other case, it's reinforcing the same process. In terms of real wages, of course, if there's an increase in a decrease in the wage share and also foreign prices increased, you have a reduction in the real wage. This is for high wage workers, and this is for low wage workers. So there's a much larger reduction in the real wage for low wage workers, and this is because they consume more tradable goods. So this is already telling a bit about inflation inequality, and indeed this is just the ratio between the real wages. So as you see, it decreases. So let me reframe. So since in one case, the real exchange rate depreciation was somehow attenuated, you have a smaller increase of the real wage of high wage workers relative to low wage workers, because since the low wage workers are more exposed to the increase in tradable prices, they will have a larger decrease in their real wages, and therefore this ratio increases in all cases, but it increases less when we have the exchange rate appreciation. And therefore this provides some information with respect to inflation inequality. So as we can see here, since inflation increased because there was a foreign shock on tradable prices, this means that low wage workers were affected more, and therefore they had in all cases larger inflation rates. So this is the inflation rate of the high wage workers minus the low wage workers. So when it reduces, it means that the low wage workers are exposed to more inflation. But this process is somehow attenuated when we have this exchange rate mechanism, and it's not when we have the capacity utilization mechanism. And then after the shock is over, the model kind of achieves the baseline scenario again. But we do have a period in which inflation inequality differs a lot between each type of worker. So to conclude, I hope that the results were clear. There's a lot of things going on, but I will try to make some sense of it now. So basically, a shock in the foreign inflation rate is by itself a distributive shock, and it leads to some sort of inflation in the domestic economy. So since there is a currency devaluation, this will be harmful for workers in two senses. First, they lose some, at least to some extent, their wage share. And also if you are talking about low wage workers, they will be more exposed to the inflation that was created by this inflationary shock. And this is like a property of the shock and is not related to the type of response of the monetary policy authority. Well, If the main transmission mechanism of monetary policy is economic activity, when we have an IT regime, actually what will happen is that the increase in the interest rates that will follow will exacerbate the negative effects on the wage share, as I said, because we are reducing economic activity and therefore increasing unemployment rates and putting the burden on workers. And it will actually also increase the inflation inequality, because the way that this inflationary shock is being controlled in this case is by reducing the inflation rate of domestic goods, because it's through economic activity and therefore through nominal wage increases in the domestic economy. So actually, we still have a very high inflation rate of tradable goods, but it's reducing the inflation rate of non-tradable goods and therefore further increasing the gap between the inflation rates of the two groups. So in this case, actually, we would have a worse situation, both in terms of the wage share, but also of inflation inequality within workers. However, and just to complement this conclusion, this means that when some people defend the IT regime, if this is the main transmission mechanism, even though we should fight inflation because it's hurting more the poor, depending on how this occurs, you're actually further hurting more the poor or further increasing the gap. So this is, I think, a way to criticize a bit this claim. However, it's also true that if it is the exchange rate, the main transmission mechanism, the situation will be less beneficial to firms, because initially you would have had a currency devaluation that is not so large anymore. So firms are benefiting relatively less from this foreign shock. Therefore, you attenuate the impact on the functional income distribution. And also you kind of protect more the poor by reducing the inflation rate that they are exposed to. So in this case, the conclusions with respect to both the functional income distribution and inflation inequality would be the opposite, and it wouldn't be so bad for the low wage workers' real income. So yeah, it really depends on the transmission mechanism. So the main conclusion of this whole framework is that the type of transmission mechanism matters for the effect of the inflation targeting regime for the functional income distribution, but also for how average inflation rates will be controlled, and therefore for inflation inequality. So really how the economy is affected by these interest rates changes impacts to both of these kind of distributive variables that we are trying to capture. Well, to finish, I have some considerations about the results, and I think to analyze them in a critical way. Of course, the model is not capturing interest rate payments to creditors, nor is it capturing changes in asset prices. So to some extent, I think it's a picture of what goes on in the distribution below the very wealthy ones and maybe among workers. And after I saw Jonas' presentation, I was also thinking maybe it's actually capturing more what happens to the very poor, because I think it's a valid point that low income households will be more exposed to the increase in the debt service. But if we think about countries such as Brazil, there's a large part of the population that doesn't even have a credit card or a bank account. And these are the ones that consume a lot in food. So maybe what we are capturing here is what happens to the very, very low income groups. And maybe it's more relevant to them. Another thing is that the international context is also relevant. So right now, for instance, if everybody is increasing the interest rate, the exchange rate channel will not really be there. And this means that maybe now responding to the shock with higher interest rates will not be a very good solution. At the same time, I also think that responding to what was going on in Brazil in 2020, reducing the interest rates was not a good solution also. So this is kind of very time specific as well, and it depends on the international context. And finally, just to make clear that we are not defending the IT regime with this analysis. Like the idea, we're not saying that it should be controlled by one way or another. It's just really, since we have the IT regime and since this is what is going on, what happens to income distribution if we have this type of response? That's it. I hope it was clear. Thank you.